You may notice, before I introduce him, that our moderator for this session is Aaron Heyselhurst. There isn't a seat for him because the amount of energy this man has got, he can't sit still for an hour. So he's going to be bouncing around a little bit like Tigger. Have you ever been called Tigger before?
A lot.
Right, okay. So let me just tell you a little bit about this session. Our last session for today is entitled Identifying Returns Through Alternative Investments and Private Asset Classes. So with fierce competition and rich valuations, attractive deals apparently are becoming harder to find. So this panel will primarily discuss where the greatest gains may lie in the future. I'd like to introduce our panelists as follows. We have the Special Consultant to the Secretary General of the Union of Arab Banks, Antoine Hobich. His Excellency Sheikh Abdullah bin Khalifa Al Khalifa, who's the CEO of Asul and Chairman of Btelco. We also have Mr. Hazem Bin-Gacem, who's the co-CEO of Investment Corp Bahrain. We also have His Excellency Sheikh Khalifa bin Ibrahim Al Khalifa, the CEO of Bahrain Bourse. And finally, we have Abdullah Marsin El Omran, who's the CEO of the Family Office. So, I'd like to now hand you over to the award-winning BBC TV presenter. Would you please welcome Aaron Heyselhurst?
Thank you. Thanks, Roy. Your Excellencies, ladies and gentlemen, good afternoon. Thank you for coming back. I have to tell you, I'm honoured. I'm very honoured to be here with all of you in this wonderful kingdom of Bahrain. And I'm excited to be here as well. Now, if you know me, you'll know when I get excited, you're in trouble. Because I'm like a racehorse ready to spring out of the starting gate. So, and I know our friends who are going to hear from very shortly are very keen to get their teeth into this topic. Now, the topic, Roy just mentioned it. Let me say again, the title, Identifying Returns Through Alternative Investments and Private Asset Classes. Now, let's be frank. I didn't get the sexiest title in the conference, I don't personally believe. Not very sexy at all. Identifying returns for alternative investments and private asset classes. But I tell you what, we will make, this is, the title's not sexy, but the topic is very sexy. And in fact, I'm going to go as far to say, my friends and myself will think this is the most important topic out of all of these 3 days. And I'll tell you why. Because at the end of the day, it's about what's in our pocket. And we're always looking to put more in our pocket. And this is what this is all about. So, in a nutshell, what this is about the rise of the private markets. Yeah, it is. The rise of the private markets. And that rise has been rather phenomenal. I'll give you an example. If we look at the world's largest economy, the United States, it still is the world's largest. China's coming, but the United States is the world's largest economy. If you look at the number of publicly listed companies in that country between the years 2000 and 2018, they fell. Publicly listed companies fell from around 7,000 in the year 2000 to around 4,000 last year. But at the same time, the number of private equity-backed companies rose. Oh, they rose all right. In the year 2000, there was around 2,000. Funny that. Last year, around 8,000. Publicly listed companies fell, private equity-backed companies rose. Yes, I think it is fair to say that the publicly listed companies, their value, it's worth a lot more than the private, but you get my point. As most of you know, if you want to be in the growth game, you've got to be invested in the private markets. It is why pretty much every pension fund manager you talk to is muttering about getting into private infrastructure, property, real estate, and a bit more, private equity. It's why more and more retail funds are looking to add some unlisted companies to their portfolio. You know, according to many market experts, they are expecting the future returns of publicly listed companies to be lower than they have in the past. And of course, that leads many institutional investors to consider allocating to the private markets. And those same experts actually give us three main points. One, of course, diversifying your risk, right? What's that? That's spreading your bets, isn't it? That's not putting all your eggs in one basket. Seeking a higher source of return. So seeking better returns from your investments because we're expecting those returns from public companies to be lower. And preparing for rising interest rates, so they say. But I looked at, right, because we're in a period at the moment where we're seeing this year a lot of interest rates being cut. I mean, again, look at the US Federal Reserve. Just recently cut again, the third time. But there is no doubt, though, that those factors, and we'll talk about that in a minute, but there is no doubt that those factors make private markets an attractive alternative to the traditional asset classes. And while I'm talking, just briefly, while I'm talking about no doubts, can I just add this? There is no doubt. We heard it yesterday, we've been hearing it more this morning, that the fourth industrial revolution is having an impact on pretty much every sector on our planet. You know, I want to say something about that. I want to say something about the fourth industrial revolution because it is something that I talk about pretty much every day on my show, or at least the impact that the fourth industrial revolution is having on all sectors across the board. And I want to tell you this, because many people ask, they say, hang on, they go, we keep talking about this fourth, right, 4.0. They go, what's the difference between the fourth and the third? Because we know the third, many understand the third. That's the digital revolution. That started in the early 60s, went to the early 2000s. We're talking about the introduction of the semiconductor, the personal computer, the internet. So technology, right? Technology. But we are still in this technological age. So people go, some people scratch their head and go, what separates the fourth from the third? Well, the experts say that the technology today, as we've been hearing, is more and more merging into our human lives. And the speed, they say, the speed of this technology today is faster than anything we've ever seen in history. History of mankind. I'll give you a quick example before we get cracking. Did you know it took 75 years for 100 million people to adopt the telephone? 3/4 of a century for 100 million people to adopt the telephone. Instagram did it in 2 years. 100 million in 2 years. That's pretty fast. I can go even better. Pokemon Go, the game. Pokemon Go did it in 1 month. 1 month, ladies and gentlemen. That is the speed that we are talking about. It is phenomenal, and I want to know, does the speed of today's technology, does it have an impact on investors and investment decisions? We know from the smart factories using artificial intelligence to machine learning, virtual augmented reality, 3D printing, the Internet of Things. This is a phenomenon that surely investors cannot ignore. Because with any revolution, as we know, there are winners and there are losers. And of course, the winners will be those companies who adopt the technology, embrace the technology to drive performance. And the losers, they'll be over there, left behind. And they are the ones I assume we don't want to invest in, over there. So, let's get cracking. You've met our friends. We've got Abdullah, Khalifa, Hazem, Antoine, or Anthony, or Tony as you like, and of course, Abdul Mohsen. So, gentlemen, thank you for coming here. Abdul Mohsen, we're going to start. You want to show a very quick video, I believe.
Please.
Go for it. Stage is yours.
This is a video that will show you how technology is an enabler and how we have been able, within a 6-month period, to basically bring down access of what used to be available for billionaires to an average retail investors. So we have developed a technology that will enable investors to see with a full look-through enabling people to understand what they are investing in, what is their cost, with the full transparency. So investors are asking for transparency because when we talk about returns, people would like to understand what are they paying for. And big components of returns is going to be impacted by how much am I paying. In the old days when we used to trade stocks, we used to pay a lot of money. Today, you can trade at E-Trade for free. I hope all of you are aware of this today. You can trade for free. So within the alternative investments, now there are ways that you can really access without paying premiums. So the ability to see and look through the investments is also going to be important. It's not just what you pay for, but to what extent do you get to see the details of your investment, where they are, how much are they valued at. The technology is a huge enabler for any average investor nowadays. So to your earlier point, technology is going to change the way we invest, the way we think. Historically, a lot of companies have thought about what works for us, but the future is what works for you as an investor as opposed to what works for us. That's going to be the key driver of what investors are going to get at the end of the day. If they understand how much they're paying and what kind of investment can they access. Do I deal only with one manager or do I have the choice to choose from different managers? And I believe the top quartile managers are going to outperform, and those who will have access to them in the most efficient way are the ones who will make the returns.
Okay. Let me start. This is a question for all of you, but I might start with you, Abdullah, if you don't mind. As a layman, you go, why do alternative investments even exist? And importantly, the speed. What do you think is behind, you personally, behind this rapid growth in alternatives for the private markets?
Good afternoon, everyone. I'm happy to be here, honored to be on this panel, and honored to be a participant in the conference. I think for you, this is not a sexy topic, but for me, it's a very sexy topic.
No, it's the title. The topic is really sexy. The title, we could have done better.
And I'll tell you why it's sexy. Because Asul is the custodian of pension assets. And today, we're trying to achieve two main things: diversification and returns. Right now, alternative investments gives us the diversification that we require, especially as correlation between traditional asset classes is going to one. And since the financial crisis, we've seen bonds and equities behave the same way. So alternatives is a way for us to bring volatility of the portfolio down, but more importantly is to get return. As you rightly said, central bankers are cutting rates and forcing institutional investors like us to take more risk. And we chase risk through using private markets. So you see private debt replacing fixed income. We see private equity replacing public equity. So the chase for yield is there, and this is what we're trying to achieve.
Khalifa, what's your take on, because you run a stock market, what's your take on this rapid growth in the private?
There is nothing to add on what Abdullah has said. Alternative investment is a method to hedge. It has different correlation to the conventional investment vehicles like bonds, equity, and so on. And I think the reason is definitely the diversification. And in terms of capital market, it's regulated against alternative investment, which is vaguely regulated, I would say, or carry more risk, usually, than the stock exchange or the conventional methods. So it depends on the level of investor. So you would find more institutional investor interested in alternative investment.
Doesn't that take business away?
Sorry.
Doesn't that take business away from you, though?
No. Well, it's challenging. We do have, for example, ETFs, which compromises alternative investment in a fund, and REITs also is another example. It's challenging for the exchanges, but there are ways to improve it. Because at the end of the day, exchanges is a hub where you link investors to issuers. And if you could securitize those alternative investment and have them and the exchange, it will be beneficial for both the buy side and the sell side.
Okay. Hazem, is it a difficult sell to investors to go, listen, we want to put some of your money into the private markets?
So first, Aaron, thank you for having me on your panel. Given how much energy you have, I feel I need to change into my gym kit, not a suit and tie. So thank you for having me. I'm going to ask you a question by asking a question. Where would have been the best place for you to make money and the easiest in the last 5 years?
I can't say, I'm not allowed.
U.S. stock market. Easy.
Oh, it's just gone record after record.
Easy. Brain dead. I can, as Abdul said, I can invest with no economics. I can put in, on average, I've had 20% a year for the last 5 years. So why don't all of us take all of our money and put it in the U.S. stock market? It has performed the best in the last 5 years. It's very natural. For a simple reason. First of all, you have to measure investing across cycles and in extended periods of time. Alternative investments have demonstrated in the last 40 years, and pretty much at least private equity have been around the last 40 years, that has been one of the most consistent, and that's the key thing, consistency, consistent returns over an extended period of time with low volatility. Risk plays an important part. If I tell you, this investment you're going to make 2 times your money, this investment you're going to make 5 times your money, which one would you go for?
Well, of course you're going to go 5, but the risk is going to be greater.
It's a function of the risk. That's why returns on an absolute term means nothing. I can make 10 times my money on a roulette table in a second. It's irrelevant. It's all a function of the risk you are taking. What alternative investments have been able to demonstrate across different assets, and obviously within alternatives there are many different asset classes. There's the lower risk, low return on the credit side, all the way to the higher risk, higher returns, venture capital. They have demonstrated over cycles and over time frame an ability to generate relatively consistent returns with a relatively low risk profile. Now, this comes with a price, and the price usually comes liquidity. Alternatives are usually associated with illiquid markets, where you do require a relatively larger equity check than to go and invest in the stock markets. However, the arrival of technology, of stock markets like what Sheikh Khalifa is doing, that provides an exit for many of the investors that do come into these alternatives. And I think more and more in the future, with the availability of markets that provide liquidity and instruments that provide technology, you'll find alternatives significantly more attractive and available to the masses.
Antoine, from the banking side, what's the role that the banking side plays? I mean, are they keen for the private markets? Are they willing to offer?
Well, I'm going to start off by a story.
Okay.
It makes it just a little more interesting. And that story has to start with an analogy. Did you ever wonder, for example, in the fashion industry, how come consistently all fashion houses pick a color, even though they completely compete against each other? Why is, for example, purple the color of the season? Nobody really knows that. But in reality, there is a committee from the fashion houses that comes together. I'm getting to a point, and you're going to enjoy it at the end. That comes together with one famous company for colors to pick that color together. And once they decide on that goal, that's the color of the season, they compete to the death on it. That's basically a bit how the financial sector works when it comes to a market, setting the trend. Now, with alternative investments, what had happened is at the beginning, that trend, that color was the stock market and the junk bonds, and then we all know of the crash. However, just as Hazem, my colleague here, has said, in 2010, they realized that, wait a second, these alternative investments were very stable. And on top of it, they got performance fees. They got 20% when when that performance investment had finished, on top of the 1% and 2% management fees. That was a dream. So they started creating all sorts of alternative investments, from purchasing real estate to refurbishing real estate, even to artwork, wine, and cars. So the scope was a lot bigger. And you don't forget that the financial sector at this stage with the investment banks. We're like the Kardashians. We're the influencers, you know? So that's one way for people should view it. We have the ability to influence investments, not only from the wealthy, because we try the investment, but by taking the money of the depositors, we become the biggest investors ourselves. So this is our role in this entire thing.
Abdullah, how do you look at the banking side, the banking role in the private markets?
I think the alternative space is now shaping the banking environment as a whole. As I said, you know, lending, so private debt is now lending to the market, but also private equity is borrowing from the market.
Right.
Private companies going to IPOs, M&As. So you see a lot of the foundation of our financial system actually is through the alternative space. So, you know, it's no longer a luxury. It's essential to have alternative investments functioning well to have a robust banking environment. Without it, I think the banking environment will definitely suffer.
Abdul Mohsin, can I ask you, I want to get a flavour of the alternative investments. Antoine mentioned some of them, you know, but what do you like? What's hot? What are some of the alternative investments that...
Yeah, look, I think we tend to forget what the client's problem is. What is the friction we're trying to solve for? What is the job to be done? And whether you look at a pension fund or you look at a wealthy individual, what is the job to be done for them? It is to achieve a 6 to 7% minimum returns. For a GCC investor, you have a 2.5% zakat, and you have an average of 3.5% inflation rate. So if you can't achieve those two, then you're not going to make it. Okay? Your money will basically just die over time. So if you look at the forecasters of where public equity markets are going to, what are they going to deliver? They're not going to deliver anything close to that in the coming 5 years. So there is no other choice to investors but to go into alternatives. So alternatives is not just about fees. Anthony, I tend to disagree with you, but it's a problem, it's a solution to a problem that an investor has. If there is a solution to that problem, separate from alternatives, and I agree with Hazem, that alternative has really consistently outperformed the public markets between 4 to 6% over a 40-year cycle. So if there is a solution to that or an alternative to that, I would love to know about it.
Yeah, well, we all would. But Hazem, what about you in terms of where you look at when it comes to alternative investments? I'm trying to get a sense of what's hot, especially in this region.
So first, whenever someone says something is hot, that's when I panic.
Yeah, right. Step away.
Avoid it. Okay, so avoiding, let's take out the what's hot out, but let's focus on what is appropriate in the next 10 years. And why do I say that? The last 10 years have been impeccable. Across asset classes, since the 2008 financial crisis, the 2009 to 2019 period, across pretty much most asset classes have been some of the more attractive periods, okay, investment periods. So now as an investor, as we look for the next 10 years, what should be our priorities? How do we take the lessons we learned from the last 10 years and how to anticipate what may or may not happen? I think if you read any research report, any economist will tell you, there is some kind of whether it's a slowdown, whether it's a financial, whether it's an economic crisis, but there is some kind of a tapering of the momentum which we have seen in the last 10 years. So how can we as an investor behave in a tapered environment? What we cannot do is cash everything, put our cash under the mattress, and sit and wait for the next cycle. We got to keep that wheel going. With inflation rates and what have you, we cannot stay still. So where would you deploy your capital? For us, I would say probably the focus is more on preservation of capital. That needs to be a priority. There is you're 10 times better off not losing your principal in investments than having a very volatile portfolio where you're sometimes making it something to lose money.
Right.
Not losing your principal is the single most important value creation tool you can ever have. So where do we focus on? So for us, infrastructure investing, particularly here in the region, is one of the, probably what we see is one of the more exciting regions. Why? Because with infrastructure investing, you're talking about usually 25-year uptake programs with a sovereign with a solid AAA rating or so.
Right.
emerging markets, there is a step function in countries such as China, India, Cambodia, Vietnam, Southeast Asia in general. And that step function is happening in our lifetime, where a couple of 100 million populations are moving into that higher consumer spending. How do we take advantage of that? And that is really something we didn't take of. And finally, I would say the U.S. I would put the U.S. as in that one of the emerging markets. Why is that? Talking about industrialization 4.0. North America or the U.S. have been one of the most open adopter of the use of technology, the use of the robotics and artificial intelligence in all parts of life, in the industry, in the manufacturing process, in the business services. And that rate of adoption, in my mind, puts North America at least at par with some exciting parts of the world in terms of the emerging markets to invest in.
But when you look at these regions, you mentioned the Chinas, the Indias, obviously you have to take in consideration, or are you concerned about the wobbles that we're seeing? China's slowing, India's slowing. The US has got growth, but the growth has slowed as well. Does that come into the picture in terms of the private markets?
Yeah, of course. I mean, look, China today reported 6% GDP, actual, some argue, is probably closer to 3%.
Right.
If the GDP growth in Europe or in the US was at 3%, this is kind of like front page news. So exciting. Okay, yeah. So it is slowing, but from a significant base and still on a relative basis, all on a relative basis. Because all you have is $1 in your pocket. I've got $1 in my pocket. Where should I put it? Latin America, Africa, US, Asia, China, Middle East. And that's why it's all on it's all relative basis. On a relative basis, even China at 3%, still significantly more advantageous than many other parts of the emerging markets.
Khalifa, can I ask you about this, the private market in the region, the GCC region? How does that compare? I mean, it's growing, but it's still behind other parts of the world.
Well, the unfortunate truth, in terms of getting the liquidity up and running, as you mentioned, and have the market for alternative investment has been difficult. There has been few ETFs that has been listed, but still not liquid as we see other parts of the world. And the means for getting these alternative investment into the capital market ecosystem is to allow more investors to come in and create liquidity. Because outside of the capital markets, there's a high minimum investment in alternative investment, and it's highly illiquid. So the key to grow it in the region is to provide the liquidity. Now, when it comes to regulation, it's highly inconsistent. So we see UK with regulation on alternative investment that are consistent with the other countries, but in GCC, the inconsistency or the MENA region, the inconsistency of regulation doesn't allow alternative investment within the region to grow the right way.
Abdul Mohsin, can you add to that?
Yeah. If you look at the private markets globally, there are two key components in developing a private market. One, as Sheikh Khalifa said, it's the regulation, the ability to establish companies quickly. You can exit from companies quickly. You could go into Chapter 11 equivalent in the US without going to jail or a threat by somebody else. Okay, those things do not exist in this region yet. Yes, there are bankruptcy laws that have recently been established in 3 of the countries, that's Bahrain, Saudi Arabia, and UAE, but they're still far away from coming close to international practices. Number 2, which I think even more important, is the depth of the financial markets. The alternative, if I wanted to buy a company and I needed financing, my only choice today is to go to the banks. Okay? Believe it or not, we are 15 years, very successful company in Bahrain. Not a single bank would lend us until today. And we're not talking about buyouts yet. No.
Antoine, why is that? I'll come back to you, but I'm just curious.
I think it's related to the first one, because the bank's inability maybe to exercise or to enforce a bankruptcy situation should there be a default. Okay? The history that the banks have gone through have been so tough. Unless there are clear regulations that you can really quickly enforce, it will be impossible to develop that kind of private markets in this region. It will be a trial and error. There are attempts here and there, but I don't think you could get it to the international standards.
The banking sector as a whole has been evolving. They've been learning from past history. It's absolutely correct that the banks have always required some sort of guarantee. The guarantee always has to cover at least more than 60 to 70% of whatever the person is taking. So that in itself is a problem, because how are you going to increase growth if you're going to start putting all these assets and freezing these assets? Banks have been learning, but I think they haven't been learning as fast.
I was just going to say, they're playing catch-up, are they not, in some way? Because Abdul Mohsen, you said earlier, before, not on stage, and well, you have said it a bit on stage, but when we were talking, the whole investment arena is changing, right? It's almost like the banks, like the regulators, always a couple of steps behind.
We have to consider one thing. The main motivators of banks is mitigating risks, which is kind of defeats the purpose. The only motivator that exists is the government in the region. Every single country where the banking system became a lot more lenient, it's actually the regulator and the central bank that has been able to give certain guarantees or allowing them to use some of the reserves that they have to keep aside, which has been done in many of the Arab countries with a lot of success. But other than that, I believe the financial sectors, if we're gonna succeed at this fourth revolution, the financial sector from top down has to be able to follow this trend.
It's the backbone of any economy. So
absolutely,
banks here have really enjoyed living off non-interest-bearing deposits, whether using the religious as a reason or otherwise, the lack of sophistication of most of people in this region. As this disappears with the introduction of the e-banking or the electronic banking that is now happening, hopefully that is going to get them to move, because they're not incentivized to lend except to a specific segment in the market.
Abdul, is there anything you want to add to that? And then if not, I want to sort of go back to your take on the region and the private markets in the region.
I think what Hazem mentioned is, if you have $1, you're free to invest it in the whole world. You have to be convinced to come here to the region and invest it. How I will be convinced to come here? By regulation, positive regulation, by the opportunity, and we believe in the opportunity. So we've seen now 2 unicorns here in the region, Kareem and Souk. So we can see that there is the opportunity within the technology side. However, if that opportunity is not available and government don't encourage the private investor to come in, that dollar will continue to go to China, will continue to go to the US. And with banking regulation as well that's coming, IFRS and all these things, lending is creeping down. And companies and businessmen will have to go to private pockets to fuel their growth. So I think it's a natural evolution, but also it has to be helped by regulation and has to be helped by investors that are willing to take the risk, but also get compensated with the right return.
Andrew, I'm going to ask you, what do you... sorry.
Sorry, I was going to add one
please.
thing. Usually regulators get a very hard time.
Yes.
So many regulations, I can't do this, I can't do that. But I think sometimes we forget that during the last financial crisis, pretty much every single person I bet in this room lost money in one way or another, okay? It's just a fact, okay? And many of us probably wished some of those institutions who either were marketing products or were taking, whether it's excessive risk, whatever it is, were a bit more regulated. So in a way, it is the right reaction to a time frame where investors, institutions and individuals alike, have been surprised. I think if you ask anyone 2008, 2009, they just wouldn't expect they've lost. How could I possibly have lost 20% in one day? That can't be right. Okay, I never thought this could happen. So in a way, it is the right. It was the last 10 years have been the right. The regulators have done the right thing by trying to put some belts and blocks in place. Now, maybe they went far, but that's okay, because that's where it starts. And then over time, you start to ease and adapt and evolve your regulatory framework based on the realities on the ground. So it's good to have a caretaker there across geographies, making sure that those who are providing investment opportunities, those who are investing, follow a certain code of conduct. Okay, and that obviously the next 10 years will be different from today, but it is the right step in the right direction given the large financial shock which everybody have lived 10 years ago.
Through that. Did you want to add something, Antoine? No?
I just wanted to say that there's sometimes a confusion between a recession and a stock market crash. A lot of people think that if the economy is not going well, it's due to the stock market. That's not necessarily true. Looking back, other than year 2000 and 2008, it's true that a lot of people lost their money, but on average, a dip of 5% in the market it happens 1.5 times in a year. So another point that I want to also drive at is the 10% wealthiest individuals own 80% of the market. So there is money to be done there. Unfortunately, if you look at the number of investors that there were from before until now, the number of investors is being reduced, especially when we're starting to talk about the millennials. The millennials, there's a major crisis about financial literacy and investment literacy in the highest countries, Germany, US. If you talk about the stock market, how it works, they don't know how it works. While years ago, almost everybody in university started playing around with the stock market or playing around in investment. And even though this technology is bringing angel investors and all these things, it has to be accompanied by pushing individuals to learn that money necessarily in deposits is not the right place to put it.
Khalifa, I don't know if you want to say something, but I want to ask you.
Yeah, I was just to add on my colleague's point. It's definitely true in terms of financial literacy. The alternative investment, although sometimes it makes sense, so I would give example for REIT. We have looked at the market analysis and did our own studies on GCC, at least on the appetite of real estate to a GCC investor. And we thought REITs would be the perfect vehicle in the capital market to capitalize on that interest, and we thought it would be hugely successful. It did. I mean, we launched the Scan REIT back in 2016. It was fully subscribed. However, the interest still was not there. So you would expect more interest, because REIT is a regulated way to deal with the real estate issues which we used to have and still have. And it just pinpoint the importance of financial literacy. So we understand REIT as someone who works in capital market, but you need to convey that to each individual. Liquidity wouldn't be created by institutional investors. Usually institutional investors have a long-term goals most of the time, and you need to get individuals involved. Now, the other side of the story would be the sukuk. We allowed individuals and our marketing team, actually the study was to allow insurance companies and other companies who are not in the primary dealer framework to enter the primary market, not the secondary. And what happened was, we were surprised that most of the subscription came from individuals. So in terms of conventional ways, there is a financial literacy in the region. They understand the benefits of a bond that yields you 7%, 6% a year, better than deposits. But when it comes to alternative investment, more education is needed.
Right. Yeah. And how do we do that?
There are two ways. You have to remember that most of the individual's interactions on most levels of all ages is with their financial advisor.
Right.
So, or now they're calling them personal banker. And this is when it came to the point where the influencers are the banks, because individuals, where they have money, commonly they ask their banker, what should I do with this? Not a lot of people know a private banker or an investor unless they amount to a certain amount of wealth, which the bank by themselves will lead you there. Okay? And these are the 2 points, either in universities, either in trainings and awareness programs, or more importantly, at the financial institutions themselves.
I want to, yep, sorry.
Yeah.
Go on. Speak up.
If I could add, there is no culture of saving. Maybe Bahrain is the exception. In the GCC...
In the GCC, you're talking
about,
right.
In the GCC, it's a culture of spending, of consuming.
Yeah.
So until that really, a paradigm shift takes place, then that ability of having a well-educated investor approach cannot be developed. That's a key part, because without the retail, it's very difficult. You could have institutional investors who would come and buy shares here through the MSCI world, but they are buy and hold. So that will not create a market for sure.
I want to talk about valuations in a minute, but Abdul, can I ask you about this? Because I think I would imagine it's very tricky. How do you weigh up the risks? Or perhaps more importantly, how do you choose a manager that does the investing in the alternative?
So first of all, we have to differentiate between the lucky managers and the skilled managers. And I can tell you InvestCorp is one of the skilled managers, not the lucky managers. So we have a process we call the 3 Ps. People, performance, and processes. So we have to judge the people, how savvy is the individuals behind the organization as an investor. We also have to check the processes from a risk management point of view, operational point of view, as well as performance. And I know performance doesn't guarantee you future returns, but in the alternative space, there's a big weightage on past performance, because these skilled managers, the top decile managers, continue to outperform going forward. To your point about valuations, so valuations across all markets are high, regardless.
Some of them are just astronomical.
Absolutely. However, if you compare S&P with private market entries, S&P is trading at 14.5 times maybe right now at the end of 2018. I think the average entry multiple for a private equity firm is 10 times. So that's cheaper than the public markets. So although as an investor we continue to be worried about valuation, however, if you compare public versus private, the private gives you a better entry form in the investment rather than the publicly listed companies.
Abdul Wilson?
I agree with Sheikh Abdullah, but there is also other components. One is the fact that the private is owned by fewer investors. The attention, the focus on management to deliver results is more. Right. That's one. Number 2 is that the alternatives have been not a way to manage money, but also a way to manage investor psychology. You don't see that volatility every day and being marked to market. So you manage to an end results over a 3 to 5 year period before you really understand if the company is really performing or it's not performing. Vis-a-vis, we've seen situations where companies are doing well in the public markets, but because of the economic situation or the volatility in the stock market, the company price would drop, and that doesn't resonate well with the average investor.
Indeed. Anton, can I ask you this? What are the misconceptions, you think?
From a strictly banking strategy misconceptions. The misconceptions are that commonly people believe that they have to do investments via their financial institution. One.
Right.
Number 2, misconceptions are that the market is very volatile, which goes back to my investment literacy. And because the generations that are closest to the crash are the ones that are heard the most of major cases of people losing their money. But in effect, there is money to be made. It's a better place to be. It's how the economy and the entire ecosystem will work. Especially if certain regions, the financial institutions, are not willing to provide certain backups for startups and SMEs, which, everybody's been talking about it, represent at least, above 90% of the industry. Unfortunately, even by statistics, the UAE has been giving 70% of the entire chunk that was given from the Middle East towards startups. On average, the UAE is number one, so a lot of countries are behind. And linked to regulations, linked to the central banking system, linked to the investment opportunities, linked to investment literacy. All these things have to be tackled simultaneously. And one, but not least, misconceptions can be very easily treated through social media.
Yeah.
It's as simple as that.
Because you've said before you'd like to fix the misconceptions, right?
Yes, I think we live in a very dangerous world right now. Interest rates are at record lows. Institutional money is forced to take risk. And there's a misconception that alternative investments is going to solve the problem and you're guaranteed double-digit returns. And that doesn't exist, to be honest. When the risk-free rate hovers around 0 and 1, you're not getting 20%. So I think the investor needs to realize, and I have to be careful, my chairman is sitting here, the investor needs to realize that returns going forward will be subdued. And in terms of, the historical 10%, 15%, 20% that they used to get could be a high single digit. And I think that's a reality that every day we're getting closer to.
Yeah, indeed. Can we have the microphones at the ready, please? I just want to ask, do we have any questions from the audience? You want to take advantage of our friends up on stage? We do. Okay, so we have one here. Can you get the microphones, please, guys? While we're waiting for a microphone, or a couple at least.
Aaron, I'd like to add something, if possible, by the time the microphones are...
Yeah, no, I was going to... Yep.
It is very important, as I said, to pick the color between competitors. There are themes that are happening today that strategically, personally, I don't think we should all want to choose everything. What do I mean by that? For my long years of loving this region, I've noticed that two things go into investments: ego and the willingness to be first and the best, which is also linked to ego. Have you ever seen a major investor that looks lavish or is not frugal? So you have to pick your investments not based on ego and realizing that maybe the future is coming. But where do you want to have that niche there? If you want to be an Olympian, you start off when you're young. If you want to be very good, you say to yourself, I won't be an Olympian, but I'll start off later on in the stages. And I just want to clarify that because there are a lot of topics that are being thrown today, but from a strategy perspective, you have to pick which area in this fourth revolution that you want to be at.
Okay. Which area then? Sorry, I'm coming to you. Take a seat and I'll come.
Thank you.
Which is he right? Is that one right?
Well, I think what's going to happen is, as time goes by, it will be even more difficult to access the right investments. More and more money is shifting into the alternative side, and it will be a lot tougher. So the ability to identify the managers who can identify the shifts between asset classes within the alternative is going to be crucial in delivering the returns.
Can I give a hint? SDGs are a major hint of where investment should be going. The UN, 17 SDGs. If you realize the financial sectors commonly follow SDGs. And even this morning, the keynote speaker was talking about mass impact.
Right, yeah.
SDGs are a very important source of where the globe is going, because these are the indicators of what is needed globally.
That's a good point. A good point. Question, sir. Did they take the microphone off you? Oh, lordy. I'll keep the microphone. I'll keep the microphone. There we go.
So, first of all, my name is Mohammed Al-Fahad. I would like to say thank you very much. I learned a lot from this, and I'm going to pose a question, but you guys are more experienced than me in this area. But when it comes to investments, I believe diversification of your portfolio is required. And so when we're talking about diversification, we mean low risk, medium risk, and high risk. So when we're talking about high risk or startups, which just have enormous potential, but you gotta have that gut feeling to be like, all right, I'm putting my money with this guy, all right, or with this team. So I'd like to ask you guys, what do you think about the startup scene, and what do you think about technology, and not just artificial intelligence, but the startup scene and investing in that area?
That's a good point, because the due diligence you must have to take when you're looking at a startup must be quite phenomenal. Anybody want to take that away?
I could. Sorry, go ahead.
I thought Hazem area of expertise of investing in ventures.
No, I will.
Let Khalifa say what he was going to say first, and then
I think InvestCorp would. It would be amazing if we see InvestCorp investing in startups in early stages as well, because within the context of the capital market, we have launched Bahrain Investment Market, which was aimed to startup to allow them, and that's before the bankruptcy law, and that's to allow them to have better financial gearing so they don't depend on banks. They would, after the first round or second round of funding, they would be established enough to go and actually list. And being listed is actually beneficial on both sides. It doesn't replace the banks lending them. Actually, the banks by themselves would love to work with someone who's regulated and listed. And it makes it easier for them to make decisions. Correct me if I'm wrong. The startup scene, however, needs more elements in the ecosystem. So within the context of the exchange, there is the listing, but there are still gaps for startup to reach the listing. And after even listing, there are gaps on the buy side, how to incentivize buyers such as InvestCorp and say, it's a high-risk investment, but are you willing to...
how do we fill those gaps, and how do you fill the gaps? Antoine, you're going to... Yep.
Yes. I'll just give you very briefly, because in the financial sector we see this every day. Startups just believe that if they have a good idea, they're supposed to get money for it. And that's a misconception. There's got to be at least documentation, reports, study, some sort of analysis. And I'm sure I'm not an investor.
Well, these guys must do that, though,
yes.
right? Yes.
But they do it for them, while banks don't want to do it for them.
Right. Good point.
That's the difference.
So if I say Mohammed, I do agree with you. I think we live in some of the most exciting times where there's this new area called, technology is a very broad term, but where so many business models, so many ideas so many transformation on how we go about our day-to-day life could be transformed through some young startups. Okay? And the beauty and I give credit to the US, what the US have really kind of demonstrated over the last 20 years is you don't need to be a PhD student. You don't need to be 30, 40-year experience in a corporate in order to launch successfully a business. And how is success defined in a business? Unfortunately, we see it with valuations and whether it's a unicorn or a unicorn. But setting all the valuation aside, because that is very market dependent, success is driven by adoption. You used the example of Instagram early on. And what is true today is that we are a generation which is very comfortable to adopt new practices, to start to use a complete random startup, and it doesn't matter where that startup is based. No one looks whether Instagram is made in California or made in Holland, or PayPal was made in somewhere nowhere, in the middle of nowhere in Europe. So the point is, that gives exciting opportunities for places like Bahrain, like GCC, where we can have the next Instagram here. Now, it's going to be something else, not Instagram, but it's possible.
Okay.
If I can just finish one last thing.
Sorry.
Exciting ideas is very different from exciting investments. As an investor, you got to look at your core competence. Where are you good or not good at? Just because you're great at investing at big industrial businesses in Germany doesn't mean necessarily you have the skill set to assess startups. And I think there are horses for courses. They will be most likely, definitely, I have no doubt, a very solid breed of Arab venture capital communities, which will be the catalyst for hopefully funding a lot of these exciting ideas in the Arab world.
Okay. But we've got about 5 minutes left, ladies and gentlemen, and we've got a couple of questions coming from the floor, but you want to add something?
Yeah, I fully agree with Hazem. This region has an amazing youth. Saudi Arabia has over 1 million Saudi students who graduated overseas in the last 15 years. That cannot be wasted. Okay, so the opportunity is there. Technology is an enabler. The myth that I would warn from is everyone wants to be rich quickly, and they believe that they could develop an app and they could be a billionaire. That's the biggest danger that exists today in this region.
Okay, good point. Where are you? There you are.
Thank you very much for your points. I represent the Sberbank group, the largest Russian Sberbank, the largest Russian bank. And, you know, you're rightly saying that technologies are bringing a lot of opportunities. But what is important to say that they're also bringing a lot of challenges. Actually, the World Economic Forum formulated the cyber threat as one of the top 5 challenges for the digital economies. And we, as the largest Russian bank, we can see that once the business is shifting from offline to online, apart from the comfort and easiness of doing business, this puts a lot of challenges. Like, for instance, for the last couple of years, as a group, having more than 140 million clients, we're a constant target for cyber criminals. And we have a huge number of attacks that we have to mitigate. So the World Economic Forum has recently put that in 2018, the losses from cyber attacks were estimated at the amount of $1.5 trillion US. And by 2022, they're going to grow up to $8 trillion worldwide. So I have a question to the esteemed speakers. How does Bahrain react to the cyber landscape and to the cyber challenge, and how much challenge actually the cyber threat put to the Bahraini business? Thank you.
Does anybody want to take that, just briefly? You have to weigh that up, right?
I think every company right now is facing the same problem. I think AI and cybersecurity, and how do I digitalize myself? So cybersecurity, we've seen tremendous spending going to that area. It's actually becoming an investment opportunity for institutional money like us.
Right.
So we're looking at startups. We're looking at people that have created cybersecurity solutions and bringing them on board. So here I'm putting the Btelko hat. So Btellko's right now is putting cybersecurity as an enterprise product for every single company that wants to protect itself. Okay. So to be honest, we see it as an opportunity rather than a threat.
So you've turned the risk into an opportunity for yourselves.
Exactly.
Oh, you smart cookie.
There are schools that specialize in hackers.
Yeah.
Every trend creates a counter trend. So you have to ride both. You just pick a side. If you think now the future is going to be in cybercrime, because that's where there's going to be need and things are going a lot faster, there are a lot of certifications, and even the term hacker, which was seen negatively, now is a profession.
It's true. Okay, I think this is the last question, because unfortunately we have to wrap it up, but go for it, sir.
Bahrain economy has probably reached a full cycle of maturity because we started earlier with prosperity in the Gulf, and then we've been overtaken with the high oil revenue. And in the 80s, when we have had a lot of oil and oil revenue, the Bahrain government started becoming the driver to the economy. Post that, now the Bahrain government wants to give it back to the private sector. But unfortunately, the way to maintain the government is by increasing indirect taxation. And indirect taxation, I find it is a killer to the economy, because you simply increase the price of electricity and you increase this fee and that fee, but it's punishing everybody, and it's not getting revenue, and the government is not sharing the success of income tax with the successful people. I think this is a major issue that has reached Bahrain, and I'm sure it will reach to every country in the Gulf. We have to have a proper taxation, income tax, corporate tax. It doesn't have to be 30, 40%. It could start with moderate, but they will share the successful business, and they will stimulate them to go rather than punish everybody and freeze the economy, as the case is.
Do you agree with this gentleman?
So let me, I'm going to use my personal example. I moved to Bahrain now a year and a half ago. And I'm fortunate in my life. I lived in many different places. I don't have you. How does Bahrain compare? Okay, and I would say that Bahrain is so lucky because they are relatively small. It's like a small business. There is a clear business plan. There is a clear path. It's not easy. I mean, everybody wishes you've got natural resources every corner you look. You don't. Okay, that's the reality. So now how can I make with the best I have? And I think what I saw in Bahrain is a nation that is very clear in its assets, its challenges, and is able to articulate where is the core competencies and how to take advantage of them. Is that going to translate instantly into success? No, it's going to take time. But at least there's a very clear vision, there's a clear plan to take this nation to beyond where historically it has been. And a lot of the innovations, a lot of the hubs, a lot of the developments, that will take time. But at least that foundation is right. And I promise you, in no other country, no other emerging country, actually, Bahrain probably ranks in the top 10% in terms of emerging countries who do have a very clearly articulated vision for the future. You don't see that anywhere in Latin America, nowhere in Africa, and only in a handful of Asian countries. So in a way, if I'm to bet, not to bet for 2020, 2021, if I'm to bet for the next medium term, next 10 to 15 years, this will clearly be one of the regions in the world I'll be deploying capital in.
And on that positive note, I've got to wrap it up. Put your hands together, ladies and gentlemen, for our friends up on stage. Thank you, gentlemen. I know Sheikh Abdullah's got a meeting to go to. I promised you. There you go. 10 minutes. You'll get there. Thank you.